Hello friends, greetings from Motilal Oswal AMC. I'm Manish Vantalia. This video clip will give you an idea about how we are positioning the portfolio next $1 trillion strategy for our investors. What's the outlook on the markets from the next near term to medium term point of view, and how is the portfolio shaped up in terms of earnings growth vis-a-vis the benchmark. So after the end of the third quarter fiscal 2023, the earnings of the portfolio have grown by 17%, vis-a-vis around 11% earnings growth for the benchmark, which is NSE 500. When we project these portfolio earnings into the next 2 years after the end of fiscal 2023 third quarter numbers, we get a number of around 23% CAGR growth between 2023 and 2025. If you look at how the valuations have shaped up for this portfolio, I think risk on the portfolio is pretty low. Valuations are at around 1.1 times PEG after end of quarter 3 fiscal 23 numbers on a trailing 12-month basis. So the P multiples on the portfolio are around 18 times trailing 12 months vis-a-vis around 23 times trailing for the benchmark as a whole. As to how the portfolio is positioned and shaped up currently, we are overweight on banks, we are overweight on automobiles, we are overweight on technology, and we are overweight on pharmaceuticals, and somewhat equal weight on industrial. So I think the portfolio has been constructed keeping in mind how the earnings growth for the entire corporate India is shaped up. I think as opposed to fiscal 2021 and 22, where a lot of earnings growth on the benchmark was carried forward by the metals and the commodities and the oil and gas spaces, where we didn't have too much of an exposure. These would be actually contributing negatively as far as the earnings growth for fiscal 23 is concerned. And the sectors where we are overweight on, visualizing your technology, banks, automobiles and pharma, as we see things into 2023 and 24, we think these are the money-making sectors. In terms of how the themes, which are going to lead the growth between now and 2030, next 5-6 years, and we believe that the 4 major themes which is going to be relevant from a portfolio construction perspective and money-making opportunity perspective is basically your consumption. It's basically your manufacturing prowess in India, which is getting built up thanks to China +1 and Europe +1. It is going to be your energy transition, because dirty energy is giving way to clean energy, and the whole opportunities surrounding that space. And the 4th evergreen theme is basically your intermediation of savings, which is financialization. So these 4 major sectors, on a bottom-up approach basis, we are finding stocks both in our Vision 30, which includes 1/3 as your private equity opportunities, as well as our flagship next $1 trillion PMS strategy, as well as AIF, cloning that PMS. So and this is where we think the portfolio is designed and constructed for. Energy transition, not too many good opportunities that we have still yet found, but the other 3 themes are very well represented. As far as the direction of the Indian markets is concerned, obviously medium to long-term trajectory is very, very bullish, as we have been alluding to the fact that this is a golden decade for India. However, due to whatever is happening in the developed world, primarily the US, the near-term opportunity is looking somewhat of a sideways market. Not too much of a fall seen in markets from these levels, because we are talking when the markets are already at around 17,000 levels on the Nifty. But I think between now and the next 3 to 6 months, or more like 6 months, we should be in a very sideways market. Post the second half of fiscal 24, in the second half of fiscal 24, we think that 20,000 on the Nifty is very much likely, and this is predicated on earnings growth trajectory on the Nifty of anywhere between 15 and 20% for fiscal 24. So risk, even as the market trajects lower, would be basically be quite low. And given that the earnings of the portfolio on the trillion-dollar PMS strategy as well as the AI strategy, I think the drag on the portfolio, which has been there for the last 2 years, thanks to the fact that earnings growth has been very strong for two major sectors where we have been quite overweight on, is technology and banks. They have been detracting performance for quite some time now. This is now, the underperformance in these two major sectors have got halted. In fact, it is aiding performance. Added to that we have stuck along with automobiles. This is helping performance, and I think industrials, which have not worked for quite some time, is now starting to work. So all in all, there has been a recoup of performance. I think earnings growth trajectory, as I alluded to the fact, is much superior than that of the benchmark, and valuations are very, very benign at about discount to what the benchmark valuations are. Gives us enough comfort both in terms of risk as to reward, as to how this portfolio is going to shape up over the next 2 years. I would believe that in terms of market segmentation, a lot of money has been made in the markets in the last 2 years in the mid and small cap space, when interest rates were very, very low, and there was a lot of liquidity, very benign liquidity sort of a situation. Of course, the pendulum has totally swung on the opposite side now, and liquidity is tight and cost of capital is higher. This is one space which is actually seeing a lot of correction on the downside. So I think the best trajectory in terms of portfolio construction for the equities piece is going to be to stay with the multi-cap strategies, which will have a blend of both large cap and mid cap. And this next $1 trillion strategy that we have having since 2007 is a blend of both large cap, mid cap and small caps. It's a well balanced portfolio of around 50% large caps and 50% mid caps. Gives you good risk and return opportunity, and I think this is very well suited for investors which have a time horizon of 3 years and above. So that's broadly what I had to say. Thanks for listening.